everyone, and thank you for attending today's webinar. We're going to spend about the next half hour or so discussing the most common retirement and planning mistakes that we see faculty make, and also talk about a few strategies on how to avoid them. I thought it'd be good to start with a little background on our team before we get started today. At Savant, we are a comprehensive fee-only fiduciary that's focused on helping our clients achieve their ideal financial futures. Our university planning team has specifically been helping university faculty and their families over the past 25 years. So we have a good sense of what typical issues that we have see faculty struggle with and see their families face as they approach retirement. We also have clients at over 50 different research campuses across the country, and we're familiar with the different retirement vendors and benefits plans, as well as typical gaps that we see in their planning. I'm joined today by my colleague, John Clark.
Good afternoon, James.
Good afternoon, John. John and I are both certified financial planners and member owners here at Savant. John has been advising university professionals across the country for the past 5 years now, and I have been for the past 13 years. Our team has completed thousands of financial assessments, and we work with over 400 faculty and their families on an ongoing basis at dozens of research universities across the country. We spend a lot of time with faculty when they're first introduced to our team, taking time to understand their goals and what gaps might exist from a planning perspective. John, do you want to just share with us today what we're going to be covering during the webinar?
Absolutely. So as James mentioned, we spend a lot of time learning about faculty members' financial goals when they're starting to just think a little bit more about putting together a plan. The nice thing about working with one type of client is we get a really good sense of common pain points for those individuals as they're approaching retirement. So it's a little easier for us to develop a holistic financial picture. Today, we're going to help those in attendance identify sort of a starting point to begin the planning process for retirement, and also share some common mistakes or missteps that we see pretty often within a faculty member's portfolio and retirement income plans.
John, thanks for walking us through the agenda. Let's get started by just talking a little bit more about helping faculty think through the where to begin. So maybe you could share with us what typically is a good starting point for individuals who are now starting to think about retirement.
Yeah, James, that's a really good question. A lot of times professors and their families are trying to answer the really big picture questions right away, like, do I have enough saved for retirement? Or is my tax situation going to change in retirement? It's going to be really difficult and challenging to answer those types of questions if we don't start by answering some more basic questions like, how much am I spending within a typical year? The first step really in all of this is beginning a process to get organized and put together a basic framework for your finances.
I agree, John. As we go through the planning process, it is important to gain an understanding of faculty members' financial circumstances. When you mention basic framework of their finances, can you just provide a little more context as to what that might look like?
Yeah, absolutely. So when we're going through the planning process, there's a lot of variables that are important to consider, but starting with just getting an understanding of faculty members' basic financials is important because it informs a lot of the very specific recommendations that we like to make. I mean, it's truly remarkable how often we go through a statement of net worth, which is simply your assets. So think of like your cash, cars, home, things like that, less your liabilities. And clients have simply never seen their financial information organized in that fashion before. It's also important to put together an income statement. This really tells us where dollars are going and will give us a chance to see if opportunities exist to be a little bit more efficient, particularly if we see a lot of discretionary income within their financial picture. We'll also spend a lot of time just looking at cash flow, and we can see some big changes in expenses, especially for families where kids are in college, or a couple might downsize their home and relocate in retirement. So really capturing where expenses are today and potentially in the future is important. This framework helps families get a sense of where they're at and kind of a lay of the land regarding their finances.
One of the things that I hear a lot when meeting with faculty, John, is that the main reason that they haven't started planning yet is because they know it's going to take a lot of time to assemble all the information that's needed. What advice would you have for someone that's wanting to get over that inertia?
Yeah, I mean, it's going to sound a little silly, but you just want to start with things that are really easy to obtain, right? So getting a copy of your most recent pay stub, retirement and brokerage account statements, and then move on to some of the more difficult things to obtain. Summary of your insurance policies, a couple years worth of tax filings can be really additive when we're looking at somebody's financial picture. And then you can move on to estate planning and look for documents like a will or powers of attorney if you've gone through that process at all.
So yeah, always a good idea to start with things that are easy and then go from there. Can you think of other planning ideas that most faculty don't even have on their radar when they are thinking about retirement?
Yeah, certainly. I would say, providing some financial flexibility ahead of retirement is something that really comes up occasionally. There's a big push to ensure that this portfolio is growing, right? And they're on the path to build their nest egg, which is terrific, but professors can often overlook, just some basic things like having enough emergency cash because they're used to having an extremely stable income stream. The other thing to think a little bit about is a banker is much more likely to provide a loan or a line of credit to someone while they're still working, as opposed to a retiree that's living off their portfolio and Social Security. So that would be one item that I see overlooked pretty often. Then the other area I would say be Medicare. Medicare is something where you want to make sure that you're giving yourself sufficient leeway to still participate within HSA programs, and you don't have to be worrying about Medicare Part B premiums until you actually have to, and that can be a point of confusion for individuals. I think in all of the examples I'm providing, it's about making the right choices ahead of going through that transition period, right? So we've talked a bit about putting together that baseline, that foundational financial information, and some important items to think about in that regard, James. And I think, it would be a good transition point to talk a little bit more about the portfolio and some things faculty should think about in that regard. And what items do you think we should start with there, James?
Yeah, I would agree. I would say that one of the biggest challenges that professors face when they get to retirement is transitioning from saving and accumulating assets for maybe 30 years or more to now having to protect those assets and produce their own income for the next 30 years. Not having a paycheck can be pretty scary, and being a tenured faculty member means basically having a guaranteed monthly income as long as you can work. And you have contributions going into your retirement plans every month. We joke a lot that professors never retire, and it is true that many of you work well past the average age of your non-academic peers, but at some point, your paycheck from the university is going to stop, and you're then going to be tasked with replicating that income for the rest of your life.
Yeah, that's a really good point, James. Aside from Social Security payments, most professors will use their retirement savings plan as that primary source for income, as you mentioned. How do they go about making sure the savings they have built up over their career will not only efficiently replicate the income that they're used to getting, but will also last as long as they need it to?
Yeah, I've found that, like with most things in life, efficiently managing your retirement savings accounts starts with having a well-defined, purposeful, and disciplined process. Success is often better achieved with following a process based on a foundation of principles than it is by looking for shortcuts or chasing trends. And I'm going to actually spend some time and walk through some of the basic principles and practices that our process for managing university retirement plans is built on. At Savant, we like to use a process called evidence-based investing.
James, I completely agree. Having a disciplined and repeatable process is extremely important. And we often hear from faculty that they think the stock and bond market is just kind of made up of random returns and events. And it's just better for an investor to just buy a few low-cost index funds and sort of forget about it. How would you answer that question when thinking about the portfolio?
Yeah, I do think it's true that trying to outperform a specific market or index or trying to time the market is almost always unsuccessful. There's some evidence, however, based principles of diversification and risk efficiency that can help investors get a better risk-adjusted return over long periods of time. And the most important aspect of an efficient portfolio is having a way to measure and adjust your risk. This is the foundation of how you're going to manage your portfolio and the blueprint for how the specifics of your plan is built. We refer to this as your asset allocation model. And at a high level, this means how much of your portfolio is in different types of investments, such as stocks and bonds. A portfolio that's 80% in stocks and 20% in bonds is going to act and perform very differently than one that's 20% in stocks and 80% in bonds. So it's extremely important to get this right, because this is going to not only be the primary driver of how your investments perform, but it's also going to be the primary factor to if you can sleep or not at night during retirement based on your comfort with risk. The best way to start this process is to find the right asset allocation model that's going to allow you to achieve long-term growth goals so that your money lasts as long as you need it, but also handles short-term risk and volatility in a way that doesn't make you uncomfortable. And once we have that model identified at a high level, then we need to dig down a little bit deeper and diversify within the major asset classes. If your portfolio is 60% in stocks, for example, what type of stocks you're exposed to makes a big difference in the risk level and efficiency of your portfolio. For example, a portfolio that has too much exposure to international or small cap stocks might have too much volatility and risk, whereas a portfolio that has too much exposure to large US value companies might underperform over long periods of time. Bonds also have different types of risk, and it's important to diversify that portion of your portfolio as well. As we saw in 2022 last year, big movements in interest rates can make bonds just as volatile as stocks in the right environment. So it's important to understand the risk exposure of that part of your portfolio as well. And John, over long periods of time, adding additional equity and fixed income asset classes has shown to decrease risk and improve efficiency in a portfolio compared to just a non-diversified basic stock and bond portfolio.
Okay, James, I think you've done a really nice job of laying that foundation of, diversifying amongst different types of stocks and bonds is important. But what about asset classes that are not stocks or bonds at all? Can you just share a little bit of detail on how alternatives can play a role in managing risk?
Yeah, that's exactly right. When done correctly, adding an alternative allocation to a portfolio can reduce the standard deviation, which is a measurement of risk, and actually help increase returns over time. This is another layer of evidence-based investing that can go a long way to preserving your assets and helping to produce income during retirement.
James, thanks for sharing all that detail on alternatives. I think that's really helpful for everybody listening. You really gave some good color on how it's important to be diversified. Can you just please illustrate how a professor can know if their portfolio is being diversified efficiently?
Yeah, it's not easy. Diversifying in different stock and bond asset classes within your portfolio is something that takes a lot of careful consideration. It's based largely on current economic events and trends. And it's important to make sure that you're staying up to date or partnering with an asset manager that's closely monitoring your portfolio's exposure based on current market conditions so that you're being rewarded and efficient as possible with the risk that you are taking. The way to measure how efficient your portfolio is diversified is by plotting it on the efficient frontier. And the efficient frontier is a way to see if you are being rewarded with returns based on the amount of risk that you're taking in your portfolio. And as we can see, there's a different efficiency point based on which asset allocation model you're using in your portfolio, like we talked about earlier. And we're going to have an offer for our listeners at the end of the webinar today, John, that will actually let them see how their portfolio currently sits on the efficient frontier line. So make sure that you listen for details about that at the end.
Yeah, absolutely. I think everybody listening will be excited to hear details on that at the end of the webinar. So, okay, now I think we understand the value of diversification and even adding things in like alternatives, or you kind of went through stable value funds within the portfolio, and that's a good time to revisit those types of investments. Can you share what else a professor can do to better manage their retirement plans?
Yeah, once you have an appropriate asset allocation model in place, there's a few other tools that you can use to help efficiently manage your portfolio going forward. One of the ones that we like to implement is something called a unified portfolio approach. And this is the practice of viewing all of the different accounts that you have as part of a bigger universal asset allocation model. For example, if you have, two 403B plans from your current university, a private IRA, an after-tax brokerage account, maybe even a Roth IRA, it can be much more efficient to view those accounts as pieces that make up the larger investment plan instead of individual unique models just working in isolation. Now, sometimes it does make sense to consolidate accounts at one custodian to help simplify things, but that's not always possible or not always in your best interest. Sometimes there's restrictions on your employer's retirement plans. Plus, if you're working and you're still contributing to those plans each month, that's something to keep in mind. IRAs have different RMD rules if you're working past age 73 or 74 in the future, and you can't mix pre-tax retirement assets with after-tax investment assets in a brokerage account. Sometimes there's even unique or grandfathered rules with certain plans, like exemption from state income taxes or unique rates that are paid on accounts like TIAA traditional that we just talked about. So instead of rushing to consolidate all of your assets at one location, it can be more beneficial for you to understand the unique aspects of your different accounts and then manage them towards a common big picture goal. And this approach allows us to take advantage of the different unique strengths of the different custodians that you have access to, and also be more efficient with things like taxes.
Yeah. Yeah, James, as you mentioned, it's very, very common for professors to have accounts at several different custodians, as you mentioned. What advice would you have for faculty if an advisor approaches wanting to consolidate all of their accounts into one custodian?
Yeah, as I said before, account consolidation can be a good thing, but it's not always feasible. And more importantly, it's not always the best thing for you. If you're speaking with an advisor that's pushing account consolidation all to one custodian, the thing that you should do is just pause and take some time to better understand your current plans and make sure that that decision is really in your best interest and not just the easiest thing for that advisor. An independent fiduciary advisor can help you put together a unified plan across all your different accounts without the bias of a specific custodian. And we can then use consolidated reporting software to easily view and manage the different accounts as one unified portfolio. After we have an asset allocation model and a plan to manage your accounts as a unified portfolio in place, then the next step that we'll want to take is to keep that overall model on track. So the next process we want to talk about is something commonly called rebalancing. And while it's extremely easy in principle, it's also one of the most overlooked aspects and one of the most common mistakes that we see professors make in managing their university retirement plans.
Yeah, James, I think this is an important concept to walk through. Can you just share with everybody listening today how rebalancing your portfolio can be effective and how it's not what people often refer to as market timing?
Yeah, and John, it is true that trying to time the market is usually going to hurt your returns in the long run, but rebalancing is not market timing. Rebalancing is a reaction to what's already happened. We let the market do what it's going to do, and then we readjust to keep your risk level the same going forward. Let's say, for example, that you started the year with a 60-40 asset allocation model in your portfolio. And during that year, stocks do extremely well, while bonds are relatively flat in performance. At the end of the year, you're now going to have more like a 70-30 asset allocation model instead of the targeted 60-40 model that you started with. If you don't do anything, and then the following year, stocks don't do as well, and they end up being down by 10%, while bonds do a little better that year, and they're now up 5%. If you didn't rebalance at the end of that first year, your portfolio is going to perform significantly worse during that second year. 70% of your portfolio is going to go down by 10% instead of only 60% of it going down. And only 30% of your portfolio is going to go up by 5%. So rebalancing your portfolio is a very important way to control risk over time by systematically selling when the market's high to help lock in gains and reduce risk going forward, and also buying when the market's low to help increase returns over time.
Yeah, James, thanks for walking us through that process. It's just a completely unemotional process that listeners can use. James, you've talked about a lot of good ideas. You've covered a lot of good ground. We've talked about proper diversification, adding alternatives into the mix, using the unified portfolio approach where we take all investments into consideration, and then finally rebalancing can do a lot to protect a retirement savings portfolio. Is there anything else our listeners should be thinking about with their investments as they approach retirement?
Yeah, there's definitely one more thing, John, and that is to coordinate your investment plan with your retirement income production plan. I mean, after all, the main purpose of these assets is to fund your retirement income and other financial goals that you have. So there needs to be careful coordination between the management of the portfolio with the distribution of income. We also want to be efficient with one of your biggest expenses in retirement, which is going to be taxes. Planning for things like RMDs, required minimum distributions, and being efficient with taxes in your after-tax brokerage accounts can also go a long ways towards your total return. It's oftentimes easier to save 5% or more with careful tax planning than it is to get an extra 1% risk-adjusted return in your portfolio. So it's very important to pay attention to that. And this is actually a good transition point, John, to hand things back over to you and talk to us about a little more detail about retirement income planning. Maybe you could share with us some of the common gaps or mistakes that you see in that area of planning.
Yeah, absolutely. Thanks, James, for handing it back over here. One of the main areas where we find actually quite a bit of opportunity is in the way of just taking full advantage of what's available to you in the way of supplemental savings programs within your university. So it's extremely common that when we look at a professor's pay stub, that they're simply just not getting the tax and savings benefit of the plans that are offered within their university program, especially if they're over the age of 50 and still have a significant amount of time until retirement.
Yeah, I would agree. I think that's one of the areas we see a lot of opportunity in. Can you expand a little bit exactly what those contributions, the contribution limits typically look like and what gaps you tend to see?
Yeah, of course. So typically when we're looking at the savings rate of a professor, we'll see sort of your core plan that you put a portion of your salary within, and the university matches as sort of the bulk of the retirement nest egg. Where we find a lot of opportunity to contribute above and beyond that program is in supplemental 403B plans. The savings rate within those plans have actually increased year over year from $20,500 to $22,500. And then on top of that, once you're over the age of 50, there's a catch-up provision. So that amount's gone all the way up to $7,500, which was previously $6,500 in 2022. So if you're doing the math, that's a total of $30,000 of a contribution limit within that 403B program. The biggest benefit, particularly for high income earners, is that those dollars then are going in pre-tax, and that can reduce your taxable income quite significantly.
I would agree that when we look at those numbers, you're typically going to get an opportunity to reduce your current taxable income while also having a lot more resources to accelerate your savings rate in retirement. What else, John, would you like to mention from a contribution perspective? Are there other opportunities as well?
Yeah, thanks for asking, James. I forgot to mention, there's also supplemental programs above and beyond that 403B that a lot of professors that can participate within a 457B plan or a deferred compensation program. That plan is going to function and feel very similar to the 403B plan. You get an immediate tax advantage just like the 403B, and it can be payroll deducted. Depending on the plan, there can be some wrinkles on participation based on income levels or what type of employee you are, but in most instances, you're able to contribute another $22,500 into that program. So in summary, there's just a tremendous amount of tax advantage savings opportunities that doesn't exist in most professions. So once individuals are getting a little bit more serious about retirement, they have the opportunity to contribute significantly, and often that's coming during their highest earning years. Some universities will even have an accelerated match option, an additional benefit. So it's really crucial to understand your current contributions and how they're working within your plan, because you want to optimize those when putting together your retirement income plan.
Now, John, when you say tax advantage savings, can you provide more context into what that actually looks like, and what are just in general, the different type of tax structures that are available for retirement savings?
Yeah, James, thanks for making me take a step back there. That actually leads into another gap that we see in a lot of plans when thinking about just building a diversified retirement income stream. You really have three tax buckets that are available to you in retirement. There's before tax, which would be any of your savings in a traditional IRA or pre-tax deferrals within a university benefit plan. All of the dollars distributed from those types of accounts will be treated as taxable income upon distribution. There's after-tax assets, which are typically like your brokerage account type of assets. that you'll hold investments where taxes have already been paid. You'll still be subject to capital gains and income taxes to varying degrees, depending on what these accounts are actually invested in. And then finally, there's Roth, which is the most tax efficient way to build your what we would call tax balance. So anything that's after tax. You pay taxes on the money today, but once you meet certain requirements, all of the gains and income grow entirely tax-free, which can simply just provide a lot of flexibility in your retirement income picture in the future. Oftentimes, when we're looking at a faculty member's financial profile, we'll see a disproportionate amount of assets in that first bucket I mentioned, in that pre-tax bucket, which means the bulk of the retirement savings for your income stream and carrying through to an estate planning perspective will be shadowed by income taxes. Now in a lot of ways is a really good time to address that gap. Today, income taxes are actually historically low in some instances for people to make conversions happen. So in 2017, the Tax Cuts and Jobs Act was passed, and among other changes, this act effectively lowered and widened income tax brackets, particularly the middle brackets, especially for married couples that are filing jointly. These lower rates are set to revert back to where they were previously, and that Tax Cuts and Jobs Act will actually sunset in 2026.
That is really interesting, and it's good that you pointed out the disparity we typically see with too much money in the pre-tax buckets. What are some practical ways, though, John, that someone could actually start to address the planning issue and build up other types of tax?
Yeah, well, there's not necessarily one size fits all, but one option for building tax balance very quickly that sticks out in the current environment would be performing a Roth conversion on a traditional IRA, for instance. This would be where you take a traditional IRA, which consists of entirely pre-tax savings, and then convert that into a Roth IRA, which would have the tax advantages that I covered earlier. You would have to pay income taxes for 2023 on the amount converted, but many individuals are actually down, significantly on their portfolios in some instances, in their investment accounts. And this would give you the opportunity to convert the IRA at theoretically a lower dollar amount than if you would have attempted to convert that traditional IRA in, say, 2021. You can make this conversion happen all while keeping the money invested in the same types of investment instruments. So it's really purely a tax decision. Another place to look would be within supplemental plans I discussed earlier. And I should say an increasing amount of plans are actually offering supplemental 403B and 457B plans that have a Roth option available. So that's something you should definitely double check on if you haven't already. The real nice thing about this option is it's simple, it provides a ton of flexibility, and the Roth contributions that you make within your university benefit plans are also not subject to any sort of income limitation or restriction, like if you were to attempt to make contributions within a Roth IRA. If neither of those options are available to you, I guess a nice backup plan would just be putting tax efficient investment vehicles in a brokerage account. That would be a reasonable backup plan.
Well, John, I think you've given us a lot to think about in terms of how to fix some immediate gaps, and especially how to add value to some of our listeners' retirement income picture from a tax perspective. As we wrap things up here, most people often want to get a sense of where are they? Where do they stand from a benchmark perspective in terms of meeting their retirement income goals? Can you give faculty members a sense on how to know if they're on track or not?
Yeah, absolutely. I can give sort of a general sense. I would say, putting together that budget we referenced at the beginning of the conversation would be hugely additive to faculty when they're thinking about their retirement income picture. If we use that spending as sort of a starting point, and then typically retirement income needs are usually going to fall within 60 to 100% of your current salary, depending on your level of spending. Another back of the envelope rule, which some of the listeners on the call today may have heard of, is the rule of 4%, which uses a 4% drawdown as a starting point. So for instance, if you had $2 million saved, you would start by pulling $80,000 from your nest egg in retirement. As planners, we really try not to be too rigid in exactly how we're calculating your income needs, because everyone's situation is a little bit different. And I actually think it's important to capture different vantage points so we can get a sense of kind of where we're heading, right? Because life's just not linear. So whether it's the 4% drawdown, We'll even run a Monte Carlo simulation, targeting your current income through a straight line projection. Getting several different views on if you're on track is important while using consistent methodologies to anticipate things like return, inflation, other variables like when are you going to claim Social Security or if you have pension income. Those are all going to be critical to developing your specific retirement income plan.
Thanks, John. I think that gives all of us listening today a real sense that it's certainly not a one-size-fits-all approach. And we really appreciate all of those that attended our session today, and we hope that you found this information helpful. Additionally, for anyone that's joining us today, or if you happen to be listening to this as a recording in the future, we're going to be offering a complimentary financial review. That's going to help give you a sense of if you are on track or not to meet your goals in retirement. This assessment is comprehensive in nature and often gives faculty members a tremendous opportunity to assess where they are and offer some specific recommendations going forward to better reach your retirement goals. So if you have an interest in completing that assessment, please give us a call at the number on the screen, and John or myself will reach out to you directly to go over the details of this complimentary review. Another way to contact us, or if you have any questions after today's discussions, there's going to be a survey immediately following the webinar, and you can message us through that survey as well, and our team will respond to you directly. We want to thank everyone that joined us again today for our discussion and encourage you to also check out all the other helpful information on avantwealth.com, and make sure that you find the link there to the University Division website as well for more specific information for university professionals. Thanks again for joining us, and we hope you have a great day.
Have a great day.